Welcome to the midweek market update where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. After that, we will be taking a brief tour through our core list of companies, and if you stick with me towards the end of today's video, I've got 4 additional trade ideas to share with you, so definitely stay tuned for that. Today was an absolutely brutal day out there, a lot of back and forth price action faking a lot of people out, mainly coming from the Fed's decision to raise rates by 75 basis points, but more importantly, Jerome Powell on the mic as more of a hawk instead of a dove, which we will discuss in today's video together. But for now, let's stick to the basics and kick it off with our sectors. Who was leading, who was losing, and where was the weight? The XLP for the consumer staple sector led the pack today by being down the least. It was down by only, big air quotes around the word only, 0.98%. Notice that everything else on the sector lineup here, as measured from today's open, that's this column right here, was down 2% or more. Really nasty, nowhere to hide. The XLE for the energy sector was at the bottom of the barrel, down 3.28% on the day's session. And as we know, it is a lightweight defensive sector, but when you see numbers like this and everything's red, there's nowhere to hide, the distribution doesn't matter so much. Where were the heavier weighted sectors? So the XLK slightly higher up in the list, but still red nonetheless. We've got an XLK that was reading negative 2.07% on today's session. The reason I emphasize the zero is because the XLF, the financial sector, the second heaviest weight, was down 2.7, right? There's no zero in that one, taking a little bit more of a beating in the financial sector. XLV is the third heaviest weighted sector that we're watching, second by market cap, and that was down 2.05%. And again, we're not so concerned with the distribution when we see numbers that are positioned like this. So the structural charts are going to continue to light the way. Let's do that now. Let's check in on this XLP to start. Some of the feedback we've been getting in the comments section is to speed it up through this section of the video. So we're going to try that on today's session. Let me know in the comments, was it just right? Was the speed good? Was it too fast? Was it too slow? Give me some feedback and we can make some more adjustments according to what you guys think. So XLP, it is technically D for defensive. We do not want it leading the charge. It is not leading the charge to the upside. There was a fake break up and over these multiple bar highs. You can see that in the upper wick, and we closed weak down on the lows. This is starting to look more like a bear flag, and with the fake out to the upside, trapped buyers, bearish sentiment, I would be looking for more of a breakdown in the XLP, so carrying this forward as bearish drag for your S&P 500. Next up, we've got the XLU for the utility sector. Double top is starting to pan out with a daily bar close underneath the neckline of that pattern. And remember, it'll be more comfortable for the S&P to try to find a bottom when the utilities come in a little bit. We're really looking for more acceptance in this gap, if not slightly lower, this section of chop right here. But do bear in mind that just because utilities come to this level does not mean that the S&P has to take off to the upside. This is just from a risk-on, risk-off perspective. We don't want utilities at the highs. To get here in the first place, it is still bearish drag for the S&P 500. Just bear in mind, it's a lighter weight sector, all right? So don't get it confused. We do want it to come in, but it is still bearish drag in the meantime as it's doing such. Next up is the XLV, the healthcare sector. We've got to spend some time here. There's no speeding it up in this one due to its importance, right? This is the second heaviest weighted sector by market cap. So let's take the time here. Really important that we closed the daily bar outside of the monthly range underneath 125. There's no arguing that this is a bearish breakdown. Even if you wanted to look at this as a range, obviously from here to here to here, you've got lower highs, and now the breakdown of the equal low for the lower low. This is a bearish development. There's no arguing about that, especially with the relatively weak close dead on the lows of today's session. So we are either looking for downward continuation into this lower zone, which is between 120.65 and 119.25, or even if this does rally, there's a high probability that we can produce a lower high up against the back test of 125. So knowing that, there's really no bullish solution into the end of the week, right? Maybe a little bit of upward pressure tomorrow for our relief rally, but when and if we get to 125, I'll be watching any signs of weakness in the S&P 500 for signs of a short opportunity, right? Short, stop over the high, look for the rollover back to the equal low, if not continuation for the lower low, and trend preservation, right? Lower highs, lower lows. So overall, the XLV is extremely bearish on today's activity. The only way we would flip to being bullish would be some sort of higher low with a break over the high here to confirm that higher low, to get back to the bull side. And obviously, with only 2 days into the close of week before we reassess on the Sunday video, very unlikely that that takes place. So this has to be bearish into the end of the week. Even if we get a rally, anything that remains underneath 125, bears are in control. Going on, right? Next up, I was going to say speeding up, but the XLK is also a heavier weighted sector. So let's spend some time here. Then we'll speed up through the rest. XLK tech sector, right? Heaviest component of them all. Just like the XLP, upper wick indicating a fake breakout. So trapped buyers, close week at the lows, outside of the 3-day balance lows, bear flag in play, the whole 9 yards. I would be watching out for either continued consolidation or a breakdown of this zone here for continuation into the June lows at 122.65. There's no way around it. This too is bearish into the end of the week. Now you might be saying, well, what if we do something like this? We're not out of the woods because we still have to contend with today's fake breakout high. If this is going to flip to the bull side, it's got to produce a higher low, at least for me, above 132.25. And again, doesn't seem likely at all in a 2-day span. So XLK bearish into the end of the week based on fake breakout, as well as bear flag pattern developing. Close week on the lows does not strike me as doesn't seem likely that there will be any miracle here into the close of the week. Next up, XLI. Let's speed it up through the lighter weight sectors here. No acceptance into the gap overhead. Close week at the lows outside of the 3-day range. To me, looking for the rotation and continuation to the downside. 85.50 on the downside from the range in here. Bearish drag for your S&P 500, even if it just goes sideways, as long as we're underneath the gap fill, neutral, not bullish whatsoever. Next up, real estate sector, obviously very bearish here with the close underneath the June lows, and I'm not as concerned with the actual price action here. Remember that real estate is such a lightweight component of the S&Ps that this isn't what concerns me. What concerns me is the fact that people's perception of their wealth, their net worth, is evaporating as their home price declines in value. So as their home price declines in value, their perception of their wealth declines, and they're less likely to spend more discretionary money, which is where we know more of the growth takes place in the marketplace. So really think about this one from a psychological standpoint instead of a purely price standpoint. So new lows here, not good. Bearish look for the S&P 500. Next up, XLY, consumer discretionary, where that growth spending takes place, right? And this one honestly still has relative strength. Notice that we are above a support trend line, and we are also sitting right on support here. So super support. If there is a quick snap to the downside that cleans up some of these stop losses, grabs the liquidity, and runs higher over the opening print tomorrow, so possibly a situation to watch out for, this would be where I look for any kind of relief rally. I would keep it in the XLY as a sector. So it's your names like Tesla, it's your names like Amazon, right? As soon as that happens, you're looking for the backtest of the 3-day lows where the breakdown came from 155.88. I'm not advocating that the relative strength here sends this thing up towards 175. Don't get it twisted. That's not the case. But if we do see a relief rally, the XLY would be where I look based on this super support. Obviously, if it just breaks down, there's no relief rally, there's no tick back higher, then of course it's bearish drag for the S&Ps, and you're looking for the rotation back here into the prior breakout level 147.82. Next up is the XLC. This thing has fallen off of an absolute cliff. There is your daily range. Let me zoom in a little more on that actually. There we go. That's probably better on your eyes. So there's your daily range, clearly underneath. I would not advocate for getting short at this point in time. Like the short was in here on the failed retests of the breakdown point, 53.70 give or take, right? So the short has already unfolded, but this is obviously not a long. Please do not try to catch the falling knife. I know we made shirts that said it, but do not try to catch the falling knife here in the XLC. Remember that even if this rallies, you can look for the lower high against 52, maybe at this point in time, and that preserves your daily downtrend, and then you can look for the reshort back to the lows and get continuation. Our lower level is 49 even, but again, I wouldn't advocate for just shorting right out of the gates here. Next up is the XLF. So again, XLC bearish. There's nothing bullish about that chart, right? XLF, what's happening in financials, clearly a breakdown of this level. So again, if we do get a little bit of a bounce, a lower high can be produced underneath 32.50, which keeps us bearish, and then we rotate into the 31.50 from in here. If we do flip to being bullish, it's got to be a higher low above 33. Why 33? Because technically we had a buy setup on the Tuesday hammer candle high. We moved above it on today's session, but we obviously got zero acceptance from the buyers, no interest from the buyers for a bit of a breakout. This obviously is not going to hold as a double bottom. And even if it did, the neckline's way up there, right? So, everything aside, this is bearish, right? I know I said I was going to keep it quick here. So XLF, bearish, looking for lower, even if it rallies, lower highs likely. Next up, XLB, materials, lightweight sector, not going to read into it too too much, 100% retracement. I would not advocate for new money shorts down here, but obviously it's also not a long. So to me, it's neutral at best, possibly bearish with a really weak close on the lows, threatening to move to the June lows. All right. XLE energy sector, last but not least here. What's happening? Obviously, your uptrend is breaking down. You had something that looked like this. Obviously, we're underneath that on this week session, and we're also underneath this area of prior support from the break and retest. So to me, this is a step in the right direction, but just like the XLU, it will require a little bit more bearish pressure to get more towards the midpoint of this as a prior range and more towards a comfortable spot for the S&P 500. So selling pressure still will be selling pressure, but this is a good look if, big emphasis on the word if, the market were to try to find a miraculous turn to the upside. Sometimes there tends to be relief rallies after FOMC decisions. To see the energy sector not leading the charge, not being up here at these most recent highs, would be more reassuring as opposed to less. But based on the chart pattern, bearish engulfer underneath the level does strike me as being more bearish than bullish. Next up, let's take a look at our ratio grid. And let me know again, was the speed of that good? Was it still too fast, too slow? I'd love to hear some feedback in the comments section. And while you're at it, thumbs up button would be cool as well. Anyways, ratio grid, top right-hand corner is actually going to show you what this is and how to set it up. But now we can get into the top four. These are the risk-on sectors. The XLK continues to look absolutely horrific underneath a descending now 50 SMA. That's the gold line on the chart here. So this, of course, is not risk-on. XLV breaking that monthly structure, I would not be surprised to see this go sideways, if not start to trickle lower, which, of course, is not a risk-on look. So the big two are already pointing to risk-on not being on. That's not a good indication. Of course, you need more than 2 of the 4 to turn risk on. XLY looks great. XLF looks great. But again, you need more than 2 of the 2 to turn risk on, especially when you're dealing with the heaviest weighted component and the second heaviest weighted component. So risk on is not on. And that should be pretty clear just based on what took place on today's session and the SPY daily trend as well. The bottom 4, these are the risk off sectors. Notice that the XLP is starting to perk up. That's not a great look for risk on. This energy sector is still holding up sideways above an upward sloping 50 SMA. Not a good look for risk on. Same thing with utilities. Not going to repeat it there. And as we talked about, the real estate sector, although from a risk on, risk off relative strength perspective, it does look good. Remember the psychology, really, of the wealth effect when people's home prices basically evaporate, right? So that's what I would say about the ratio grid. It is still pointing towards neutral to slightly risk off with these things starting to perk up here in the bottom 4, and that should make sense based on our SPY daily trend. Let's take a look at the TNX now, which is the 10-year interest rate. And this, we've been keeping it very simple, so let's do our little joke here, right? Number 1 is that the market likes lower rates, and number 2 is that the market likes sideways rates, stable rates. So let's again take out some laughs. Is this line horizontal, indicating stable? Absolutely not. So we don't have stable rates. All right, so then are they lower? No, if we add the directional vector of an arrow, they are certainly not lower by any stretch of the imagination. So the market, it shouldn't come as a surprise, is not content with these higher rates. We know that higher rates put more pressure on the XLK, the tech sector, the heaviest weighted component of your S&P 500. So this should make sense. Now, do we think that rates will turn around and dramatically move lower like this at any point in time? Not really. The Fed basically came out today and gave us the 75 basis point rate hike, but what was more important than that, what the market really did not like, that secondary down leg, was caused by Jerome Powell saying something very specific. He said, number 1, that the real estate market will continue to feel some pain, and if he were a new home buyer, he would not recommend trying to buy a home right now. He would say, wait for prices to come in a little bit. There's going to be some kind of correction. So again, draw it back to that real estate breakdown we gave you here. People's perception of their wealth is not going to be increasing. It should be decreasing if the value of the home is decreasing, which is not good for discretionary spending, not good for growth. That is bearish takeaway. Number 2 was that he came out and he said that rates will have to be higher for longer than originally anticipated. So a new SEP, Statement of Economic Projections, came out reaffirming exactly that sentiment right there. There were some things about the unemployment rate as well, not looking great, right, for the future and the implications of what will have to happen with rates. And if we take a look at our tracker, we are on track, no pun intended, for November to be another 75 basis point rate hike. That's what the market is currently pricing in based on the hawkish sentiment of Jerome Powell today. The current rate is 300 to 325, and in November, we're looking to get up towards 375 to 400. If we go out to December, the end of the year, as of right now, it's being priced in that we would get a 50 basis point rate hike, but I don't know. I wouldn't hold my breath on that one. It's certainly possible that we could get another 75 into the end of the year. So just things to be cognizant of. This ultimately doesn't impact day trading, but from a macro perspective, I know you guys do enjoy that breakdown. So that is your TNX, and that's what I have to say about that. Let's move on over to the VIX now. This is still an absolute head scratcher. Given all of the information that we took in today, given the breakdown that took place, given the fact that rates will have to be higher for longer, why did we just get a bit of a fake break in the VIX of the upside and then close right where we opened, right? I would have assumed that, the new information from the SEP release would have been like, okay, kind of close at the highs and maybe this starts trending to the upside. It didn't. So still a head scratcher. To me, that one's not making very much sense still here in the VIX. And it just goes to reaffirm, right? If we take out the June lows, maybe even at this point in time, June lows only means 36 in the VIX. So if you're waiting for a capitulation type bottom, a huge flush out, we've got a long way to go. That's what this would indicate to me. Next up is the VVIX. So this is the volatility of the volatility index. And again, another massive head scratcher. This not triggering at all anyone. No interest in buying SPY puts, no interest in buying VIX calls. It just didn't happen. This did not tick higher. You would expect on an event, an announcement like today, for this to move at least to the highs of the range, but it's at the midpoint. It's at the midpoint, which again is still just a major head scratcher for me. Volatility still not totally adding up. The one thing that did improve slightly and is starting to make a little bit of sense, and maybe these futures traders are the smart ones, right? If we look at the, what do we want to look at here? We want to go up. We want to go up, up, up. Oh, nope, maybe we want to go down. We basically want to look at the comparison. Yeah, here we go. From the October to the November, I got to go a little bit further down. All right, and I know the volume reads are paltry here, but that's because it's after hours. If we were looking at this in the normal trading hours, this volume would not be 623, 643, and this would not be 206. It'd be a little bit more meaningful. But what I'm getting at here is that we have achieved finally a state of backwardation, which is just, acknowledging that there's a lot of risk in the present that necessarily smooths out in the future, right? So here we go. Current VIX contract, the October, is priced higher than the November. So this does make sense. This makes sense to see this type of backwardation, when the marketplace is pricing in, okay, right now what's going on is way more uncertain than what we can see in the future, right? So this does make sense from that VIX and sort of risk perspective. Maybe that will start to correct in the VIX itself tomorrow, in the VVIX tomorrow. I'm not entirely sure, but something I'm keeping an eye on. And I did sort of get a little bit of comfort, at least, seeing that we moved out of contango into this state of backwardation. Just an acknowledgement, really, from the market that, yes, there's a lot of risk out there currently. Not so much in the future, but currently, right now, right here, we are acknowledging, yes, there is some risk. So that was, again, what that means from a day trading perspective. Expect volatility to continue is ultimately it, right? This is not going to dry up suddenly and just, really tight range 50 cents back and forth, right? So don't expect that anytime soon. Expect continued expansion of ranges. So with that being said, let's get into the S&P analysis here of what the price charts are telling us for the SPY, right? So obviously we broke down from the 3-day lows right here, extremely weak close on the lows after filling this prior gap. So it's no longer yellow, but we actually closed underneath the gap fill. We are technically still within the week's expected move, so we are not extended from that perspective. But once again, I would just remind you, it may not be wise to just chase this short on the open. There have been times where we get a complete reversal the next day after an FOMC decision. So if you are looking to short this, and yes, the bias out there is short, let me be abundantly clear about that. I'm not saying that, we've got to still be bullish on this thing. Obviously, we've changed our tone a long time ago, but you're looking for the rotation, a little bit of a rally to get into the backtest of the breakdown point, 382.25, to position for shorts, just like we talked about in the XLV, just like we talked about in the XLF. If that happens, stop goes over the high, look for the rotation to the equal low, if not continuation into 372. 372 is coming from all of these touches in here, the sort of range, if you drew it in horizontally, from in June and July. So those are the downside levels. And again, I would not advocate for just smashing it short on the open tomorrow. I'd be a little bit more tactful than that. If we drop it to the hourly time frame chart, I want to show you where we've come from, right? Because there was certainly a massive flurry of volatility and price action on today's session. At one point we sold off, at one point we ripped, and then we obviously closed weak. But the reason we have so many overhead levels are because that's where the breakdown came from initially. Here's the consolidation from early on in today's session. That's 386. Anything above that, the volatility that did rally us a little bit when Jerome Powell initially started talking, was up at 388.75. And all of these levels, let me remind you, are underneath our weekly 390.85. So bears in control no matter how you slice the cake here. If we rally, first short look is for here. If we continue, there's another short look at 386. And if we go sideways in here, fine, I will consider it. Have to reevaluate how it happens, when and if it happens, if this is a look below and fail and we start to see any sort of rotation back higher. One step at a time, but obviously bears do seem to be firmly in control at this point in time. Let's continue along into our internals. So bear with me as I switch screens to the internals. There we go. What do we have on the internal screen? What is the main takeaway from this? We cannot read into the internals of what happened on today's session. There's just way too much volatility. This, I would say from a volume perspective, maybe, right? The fact that there was so much volatility, but we still ended up closing underneath that significant negative 300 million mark. Yeah, I would say that that actually is some significant, that's a reasonable takeaway from the internal screen. But advanced decline line, not, you can't really make much out of this. Obviously, everything earlier in the week was bearish. And then in the ticks, again, the main takeaway here would just be that everything earlier in the week was supporting bearish thesis, even as we were just ultimately going sideways in the S&P 500. So the bearish activity, I should say, does make sense based on what the underpinnings of the market are telling us, and the outflows based on volume do check out as also supporting that kind of idea. No major red flags. This will be more of a reset for Sunday's video to see how things pan out after, post FOMC. Let's take a quick peek at the market profile. If you don't know what this is, and by the way, let me just rewind very briefly. If you don't know what this is, top right-hand corner shows you how to set it up, what it is, what it all means, how it'll help you intraday. Market profile, again, video, top right-hand corner, shows you what it is, how to set it up, and what it all means, how it'll help you make better intraday trading decisions. This is where I start to see the possibility of a snapback rally, a little bit of relief. What we're always looking at in the market profile, the main takeaway we get from it is, where is the value area? Notice that the value area is higher. So we put in this sort of big spike taper at the bottom, but all of the value, all of the volume went through up at the highs in the midpoint, basically, of the prior 3 days worth of consolidation. So are we a bit extended to the downside? The value area certainly would suggest that. So that's why I'm saying you probably don't want to go short right out of the gates at these lows. I think the point of control up here can act as a bit of a magnet, and if we do start to see some rotation higher, I'm not saying we get all the way here, but again, just a retest of the breakdown point does start to become attractive because it's also the value area low. So two things coinciding, we call that a mechanical level, right? All of these prior supports, pre-market, in here as well. Mechanical level, I'll give you the number right now. In the futures, I would be watching 38.47. 38.47 in the ES based on the market profile, and the value area point of control remaining higher on today's session instead of shifting lower with price. This is a little bit of a spike as well. So carry forward spike rules. There are three things we watch out for. Number one is opening above the spike, and the spike, by the way, is this segment right here, single prints. We, currently don't look to be opening above the spike, so that's off the table. Opening in the spike is acceptance of these prices. Expect two-sided back and forth. Opening below the spike, you're looking for more auction to the downside to find the next set of buyers. So just carry that forward for tomorrow's open. We'll, of course, talk about it in the pre-market live stream, but if you're not going to tune in, then definitely watch out for that to help inform your opening trade decisions, all right? So that is the market profile. That is what I've got for you in the S&P 500. Let's round out the rest here with the QQQ. We'll go back on over to the daily time frame, IWM, all that good stuff. What do we see in the Qs? Same sentiment will apply. I'm not going to walk through all of the same psychology, but big fake out to the upside, rejecting off of the prior breakdown point. Downside trend remains intact. Downtrend here, right? Lower high, new lower low. Just like we talked about in the ES, watch for a little bit of an early rally. Anything that fails at 286 is shortable for the rotation lower. Your target's going to be 280.75. There was no gap down below to be filled, so you're just looking to come into these two equal lows there. Anything underneath are the three lows from here, so just continue to walk them down. That's 276.75. If we rotate back into and above 286, it's not the end of the world. There still is a short opportunity. If we zoom in on the retest of the breakdown point, just like the ES, we have that similar structure. Your number is going to be 289.50 as a nice round number there. If we do start to get acceptance above or just sideways up here, it may start to become the look below and fail. But again, one step at a time. The bear's clearly in control for now. It would really require a big reassessment to see if that look below and fail is going to pan out to become something larger, right? As of right now, again, it's just very clear that bears were roaring, for lack of a better term, right? We'll use a little bit of a metaphor there. So here we go, IWM. What's going on in Russell 2000 and the small caps, finally playing that game of quote unquote Heinz ketchup, if you will, breaking down underneath the lows, finally getting more in sync with the other indexes. This is more of a risk off look, breaking down under the 3-day lows, prior breakout point. It all makes sense. It's the same thing, right? Back tests of 177 are bearish. Look to position against that for the rollover. We've given up the trend line now, so let me remove that from the chart. That's no longer helping us out for a super support. We've just got horizontal levels. Failure to go higher as well with the big upper wick there. So again, it does strike me that bears are in control, but it might be a little bit difficult to catch the short early based on the value of today's session being primarily inside of the 3-day range. So don't short it on the open is the main takeaway for all of the broad market. Wait for a little bit of a rally and short into a lower high. Let's get through the core list of companies now. We've got Apple up first on the chopping block. What do we see here? At first, it looked great for a look below and fail here on the prior daily range. We had some price acceptance above. We talked about this in the live stream on the morning, but just FOMC. FOMC, that's all you can say about a day like today. There's just too much risk out there to get overly directional as you have these looming events. But going forward, what do we see? So a failed move above the top of what was the prior daily balance range right here, and now starting to flirt with another breakdown of the lows off of a lower high. This one perhaps has the cleanest trend line. I don't have it drawn in officially, but if I just sketched it in, boom, you can see right there, rejecting right off the trend line. So nonetheless, if we do see a breakdown of the 2-day lows here, just look for a rotation into 150.85. Anything underneath that 147 is your target. Anything that chops around in here, I do not want to be involved until it picks a cleaner direction. Next up is Netflix. This is the ultimate tease here underneath this 250, a really large 80-point overhead gap. You don't need to nail it on the initial entry. You should not be looking for longs up here at the highs. In fact, we broke down underneath the inverted hammer low, and we are coming into the back test of this 234 level. To me, I would be patient in here, and then a breakdown of that, that's where I would look to short Netflix for the look above and fail. That would be more of a confirmed look, better look to me than what we just saw in Apple. So that strikes me as the more easy trade to pull off based on the structure being cleaner. 234 is kind of what you're looking for to break down in Netflix based on two inverted hammers, look above and fail. Target would be the bottom of the range here, 220. If it is going to move higher, fine consolidation, want to see a higher low into the overhead gap before I even start thinking about that unfolding. Next up, we've got Tesla. Remember that this is in the consumer discretionary sector. So if the XLY is strong and produces what we talked about earlier, I would watch for this trend line to quickly flip below, recapture, then rally back up towards these highs. This is still going to be a breakout point at 311.70. So 311.70, carry that forward in Tesla. If we can get back above, fine. There's a little bit of an opening overhead into 325. If we get more acceptance underneath today's low, that's where I would just look for, chop in here. Day trades fine, 2-minute, 5-minute pattern scalping. It's fine, but overall direction is only going to be clean up and over this 311.70. Choppy in here, maybe a better short if the 50 SMA and all of this support breaks for the rotation into this over the course of time. But one step at a time, that does seem to be a stretch. This breakdown that I just outlined seems to be a bit of a stretch into the end of the week. Next up, we've got Google. What's happening in Google? This too is just, don't chase it short here at the lows. I think it can see some snapback, put in the lower high, and then we can look for the rollover. This does have a juicy gap underneath us to start filling. We've got 99.60 down to 97.44. Just be mindful of that on the downside. So it might be a little bit tough to resist just chasing it short here, but I think your risk reward shorting it at this stage in the game is just too skewed. Where do you put your stop? Is it right above the high of day? Very high probability you get stopped out on any flurry of volatility, any flurry of a relief rally, right? So to me, not worth shorting these things at this stage in the game. Watch for your sort of dead cats into 101.75 or 104 would be another reasonable area to short from a higher time frame perspective, right? On a weekly chart, you've got a range, break, retest, and then lower high off of that. Beautiful, right? So that's your 104. Next up, we've got Meta. This is going to be very similar, right? Don't short it at this stage in the game. We're so far aggressively down. We're into support. Next level underneath is 134. There's some decent range to be trading for to the downside. So let it do something like this. Let it fail early on in the day, and then look for your breakdown. Don't just slam it short here on the open. If it does, work out, then fine. I look like a dummy in hindsight, but guess what? I'm protected. I'm not the one shorting here when it rallies saying, oh no, I just lost my shorts, right? No pun intended. So that's what I would say about Meta. That's what I just said about Google, right? Watch for the thing to rally a little bit and then roll over to the downside. That's kind of the MO here. Now you might be saying, well, we're breaking out of a 3-day range. Of course it has enough legs to continue lower. Well, it might, but my issue is just where do you put your stop unless you have that initial failure to move higher early on in tomorrow's session. Okay, so that's what I'm trying to be mindful of here and not chasing these things at this stage in the game. So Meta does look bearish, but pretty tough to pick out a short entry initially. Next up, we've got NVIDIA. This one, on the other hand, does look like a really solid trade setting up for tomorrow. Reason being is the nasty, horrific upper wick and the inverted hammers stacking back to back. So if we break these 2-bar lows, great. Now we just have a target. We move to this low in here, 127.82. This is much more reasonable. So intraday pattern that sets up, you've got a tight risk reward here. Look at that. That's beautiful. This is really what you want to watch out for, not so much shorting into the lows, Meta, which has already broken down, right? So NVIDIA, I like the chart setup that's unfolding here with the inverted hammer, short under the 2-bar lows, looking for that rotation there. Next up is going to be Microsoft. This is going to be another one that you don't touch on the lows because it's already given us the breakdown. Failed breakout, failed move higher. I did think it was trying to make that double bottom here from the monthly timeframes we talked about at pre-market. It didn't work, right? So to me, looking for continuation to the downside, but again, probably not going to be it's not going to be easy to pull off the short dead on the lows here is what I'm getting at. And that's been the case for almost everything we've seen other than NVIDIA and Tesla perhaps, and maybe Netflix as well. Everything else, pretty tough to pull off the short. And last but not least is Amazon, the mini beast. What's going on here before I give you those 4 trade ideas? This one breaking down from the 3-day range. Again, you don't want to be shorting it here. Wait for the rally, wait for the retest, lower high, and then position more tactfully with a stop loss in place. Better risk reward. If it wants to go sideways and put in a flag, then fine. Over that course of time, now you have a breakdown level. Now you have a stop. But currently, it's just so tough to pick out, right? Because you've got prior structure right in here, 117, literally just underneath us. So short doesn't look too appealing inside of Amazon. I also don't know that I would be looking to capture any of these rotations to the upside with the market feeling such a firm downside bias. All right, those were the core list companies. Now let's take a quick blast through these trade ideas. Ford. 3-bar play possibly setting up. We've got a 1, we've got a 2. Next bar takes out the lows is our 3. The target is right here to 1260. Obviously, this is only a 40-cent range that you're kind of trading for. So it's not the most lucrative trade, but the pattern looks good and the news flow is right around it, right? There's some bearish catalysts out there as well. Just looking to take advantage of a quick scalp here to the downside in Ford. Not interested if it never breaks down or if it takes out that bar's high. We're out of here. There's no reason to stick around and continue to watch that. Next up is J&J. If you think about what we just discussed in NVIDIA, how there's a clear target, a clear stop loss, this has breached the inside bars here. Inverted hammer, fake breakout to the upside. If we take out the low on an intraday pattern there, boom, you're shorting into these 2 double bottoms around 160, 140. So this makes sense to me from a risk reward perspective, watching out for early shorts inside of Johnson & Johnson. I would say ideally the rally wants to backtest 164.30, fail, and then roll over for something that does that. That is the setup there. Not interested if it starts chopping around here, getting price acceptance higher. Next up, we've got Mickey D's. MCD is the ticker on that one. Very similar. This is just barely closed underneath this double bottom, and we've got another double bottom as a target here. So anything that remains underneath 251.76 on the intraday early on tomorrow, there's enough risk reward here still to make the downside trade worth it on the intraday, right? If I go to an hourly chart and zoom in here, let me adjust this and just give you very, very brief risk reward, right? So if your stop goes above that, if we start getting acceptance above, you're out of there. Stop goes here, entry can go somewhere in here based on a bearish breakdown pattern, and targets here. Of course, that makes sense, right? So that's what you're watching out for. So McDonald's bearish trade based on that kind of thesis that we've just outlined. Last but not least is ZS for Zscaler. 2 inverted hammers back to back, breakdown of the lows gets us to here, and then we have gap to fill underneath. That's why this one is attractive. It's not so much that this is more of a swing idea, right? So it's not so much that this risk reward is attractive. It's inverted. That is not attractive. But if we can break the lows, move into the gap, and fill that gap to here, then of course, an entry there, a stop here, and a target here starts to make a little bit more sense. So there's your risk reward on ZS and what I'm looking for in the setup. Obviously, if it just remains above or if it starts bouncing aggressively off of the bottom of the gap, or top, I suppose, in here, then that's where you want to be out of this one in a heartbeat. So that has been the breakdown. That is the midweek market update. Again, drop me some comments drop me some feedback in the comments section. Almost said that one backwards. And I wish you all a green trading day week.